Hello everyone, welcome to Big Players.
In this video, I will be sharing the best ways of combining indicators and how to use them for your trading. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. Indicators are technical tools that can be used to assist our assessment of the market conditions. In other words, indicators help us in identifying the market condition with ease. Some traders use indicators as a buy and sell signal. And that is perfectly fine. But I like to think of indicators as a gauge to measure different aspects of technical analysis. As traders learn more about indicators, they start combining different indicators to find a trading system. The problem is that their chart ends up looking something like this. Can you tell what is the problem with this chart? The problem is, all these indicators show the same thing. They are all very similar to each other. They all indicate overbought and oversold conditions. They use the same inputs. Hence, their output will be the same. Therefore, we could use just one of these indicators to show us the same information. So, the other two indicators are just useless. Instead of these two indicators, we could use other types of indicators that would help us in identifying the whole market scenario. Hence, combining the best possible indicators can give you an extra edge over the market and help you make better trade decisions. So, now let's learn how to find the best combination of indicators. First of all, we need to understand different types of indicators. All indicators can be generally divided into three types. Number 1. Trend indicators. Number 2. Momentum indicators. And number 3. Volatility indicators. Let us begin with trend indicators. As the name suggests, trend indicators are the indicators that help us in identifying the trend of the market. The market typically moves in three directions: upwards, downwards, and sideways. Trend indicators help us in identifying the direction of the market. Identifying the direction of the market is very essential. This is because, if we trade in the direction of the trend, then the probabilities align into our favor. This is why a lot of traders say that the trend is our friend. Moving averages, super trend, and parabolic SAR are some of the most popular trend indicators. Each of them show us the trend of the market. Number 2. Momentum indicators. Momentum indicators are tools that help us in identifying the strength or weakness of the trend. If the market is in an uptrend, we will be looking to buy. But if the momentum of the uptrend is weak, the trend could easily reverse. On the other hand, if the market is in an uptrend and the momentum is also rising, we can expect the trend to continue in the near future. Hence, we want the momentum and the trend to be in our favor. The RSI and stochastics are some of the most popular momentum indicators. They both show us overbought and oversold regions in the price. Hence, they can help us in identifying reversals. Number 3. Volatility indicators. The market generally moves from phases of high volatility to low volatility. This means that the price will sometimes face difficulty in moving in a certain direction. Hence, we see a choppy price action. Other times, the market will move with ease. Therefore, we see parabolic moves. Volatility of the market gives us an indication if the price will move towards our target with ease or not. Ideally, we want to trade in high volatility markets, and we would like to avoid the low volatility periods. ADX, average true range, and Bollinger Bands are some of the most popular volatility indicators. Now that we have understood different types of indicators, it is finally the time to create the best combinations of indicators. If we think logically, the best way of combining indicators will be to take one indicator from each of the above-mentioned categories and try to depict the market conditions. For example, let us take a 50-period moving average from the trend indicators. We will take the RSI from the momentum indicators. And finally, we will take the ATR from the volatility indicators. Once we plot these indicators, the chart will look something like this. First of all, we will look at the moving average and determine the trend. The price has constantly stayed above the moving average, and the moving average is also sloped upwards. Therefore, we can conclude that the price is in an uptrend. The recent price actions indicate that there has been a small pullback in price. Currently, the price is near the moving average. We expect the price to find support at the moving average, and hence we are looking for a buying opportunity. If we look at the ATR, we can see that it is clearly rising. Therefore, it is a good sign as we can expect high volatility. So now, we want to look at the RSI to trigger our entry. On this candle we see that the RSI is clearly starting to move upwards. Hence, the momentum of the market is rising, and this is a very good place to buy. So we buy on this candle. As you can see, the market made a dramatic up move after our entry. An important point to note here is it is not necessary to use an indicator from all the three categories. Even if you use one indicator from two categories, you will still end up getting a good view of the market. For instance, let's take a 50-period moving average from trend indicators. And let's take the stochastics from the momentum indicator. Here we see that the price is in an uptrend, because the price is trading above the moving average, and the moving average was sloped upwards. So we wait for the price to make a pullback. Here, the price pulled back to the moving average. So we wait for the stochastics to give us a bullish signal. The stochastics makes a bullish crossover here. So we can say that the momentum of the market has switched upwards. Hence, we expect the market to move up. So we buy here. And, as you can see, the price gave a strong up move after our entry. Again, I am not saying that you should use the exact same combination of indicators. Instead, I want you to understand different types of indicators, and avoid overcomplicating your chart with more indicators. That brings us to the end of this video. I hope that you have now understood how to combine different types of indicators to analyze the market. If you found this video useful, then be sure to like this video and subscribe to our channel, so that you don't miss on any of our new videos. See you soon.